In this video, I'm going to talk about FXStabilizer EA. At first glance, this EA looks very impressive. It has a long public forward record, and if you only look at the performance numbers, it can seem like a very strong system. But my conclusion is actually pretty clear. The performance looks good on the surface, but the structure underneath is much riskier than it appears. I believe FXStabilizer should not be viewed as a stable, low-risk EA. Instead, it makes much more sense to see it as a high-risk mean reversion EA built around grid and martingale logic. In this review, I looked at the public forward results, the vendor's backtest, and the actual trade history to understand what this EA is really doing and where the real risk comes from. Let's start with the core structure. FXStabilizer is basically a countertrend EA. It is not a scalper, and from what I can see, it clearly uses both grid-style position adding and martingale-style lot escalation. In other words, when the market moves against the initial entry, the EA keeps adding positions, trying to improve the average entry price, and then closes the whole basket when price retraces. That kind of structure often looks very strong in normal market conditions. Why? Because many moves eventually pull back at least a little, and that small retracement is often enough to get the basket out in profit. But the real problem comes when the market does not retrace. If the trend keeps running in one direction, floating losses grow, more positions are added, position size gets larger, and the overall risk expands very quickly. That is the single biggest issue I see with this EA. Now let's look at the public forward performance. To be fair, the forward record looks attractive, the equity curve looks smooth, the returns look strong, and at first glance it gives the impression of a well-performing system. That is exactly why I think this kind of EA needs to be examined more carefully, not less. One important detail is that the public forward is running on a USD cent account. That matters a lot. With cent accounts, the numbers can look psychologically less intimidating than they really are. The format can make risk appear smaller than it actually is, especially for people who are just looking at the headline figures. So even if the performance looks clean, that alone should not lead you to assume the strategy is safe. And that brings me to the most important point. I do not focus mainly on the headline numbers. What matters much more to me is how the profits are being generated. When you actually look at the trade history, the pattern becomes much easier to understand. There are sequences where lot sizes increase like 0.01, 0.02, 0.04, 0.08, 0.16. That is a very familiar pattern. It suggests that when the market moves against the position, the EA keeps adding trades while increasing size and then tries to recover everything on a reversal. It wins small over and over again, and it can look very stable while doing so. But underneath that smooth appearance, it is building exposure. It can become very dangerous if the market keeps moving in the wrong direction. The way positions are closed also supports that view. From the trade history, it does not look like the EA is managing each position independently in a precise way. Instead, it looks much more like it is holding multiple trades as a basket and closing the whole group once the combined profit turns positive. In ranging or choppy markets, this can work very well. If price pulls back just enough, the basket can recover and close in profit. But if the market keeps trending, that same structure becomes a serious weakness, so the strategy can look very strong during normal periods. But that strength comes with a hidden cost. It may be extremely vulnerable to sustained one-way markets. Another thing that stood out to me is what happens around the deeper drawdown periods. There are phases where the account takes a noticeable hit and then appears to recover relatively quickly afterward. At first, that may look impressive. Some people might see that and think, okay, this EA can survive bad periods and bounce back, but I don't see that as an automatic positive. In some parts of the record, it looks like the base lot size may be larger after a drawdown than it was before. It could mean the system is taking on even more risk after losses. Now, I can't prove from the outside whether that was fully automated or manually adjusted, so I don't want to overstate that point. But at the very least, I do not think it is safe to assume that an ordinary buyer can just run the same EA with the same settings and reproduce the exact same clean performance curve. That leads to another major issue. Account size matters a lot with this kind of strategy. Grid and martingale systems are heavily dependent on the relationship between balance, lot size, and how far the market moves before retracing. A larger account may be able to absorb moves that would completely destroy a smaller account. This is one of the biggest mistakes people make with EAs like this. And that brings me to survivorship bias. With grid and martingale systems, survivorship bias is a huge issue. If enough accounts are tested, eventually one of them may survive for a long time and produce a beautiful equity curve. What you see publicly may simply be the one successful survivor, while all the failed variations remain invisible. That is why I do not treat a long public forward record by itself as proof of long-term robustness. It is useful information, yes, but it is not enough. Now let's talk about the vendor's backtest. Just like the public forward, the backtest also looks fairly good on the surface. The performance statistics seem respectable, but again, I think it is important to stay very calm and objective here. A backtest is always a result produced under conditions chosen by the vendor. It reflects the vendor's environment, the vendor's settings, and the vendor's preferred presentation. And for a grid Martingale EA, the most important question is not whether the profit factor looks decent or whether the win rate looks high. The real question is this: how far can the market move against the system before it breaks? Where is the real failure point? And how much of the account is lost when that point is reached? That is what really matters. If the EA also uses variable risk or auto risk sizing, then the results become even more dependent on the account balance and trading conditions. So I do not see the backtest as proof of stability. I see the backtest more as a polished example of how attractive a grid martingale strategy can look when presented under favorable conditions. Finally, when I map the actual trades onto the chart, the logic becomes even clearer. The EA appears to enter in a counter-trend direction, then add positions at fairly regular intervals and increase size as the basket develops. Eventually, it closes the group once the combined position returns to profit. That is not some mysterious or highly sophisticated black box behavior. At least from the outside, it looks much more like a classic grid and martingale framework. There may be extra controls inside the system, and I want to be fair about that. But based on what is visible from the trade history, I believe the core structure is relatively straightforward. And that is why my overall conclusion is simple. FXStabilizer may look attractive when you focus on the public performance. But once you dig into the trade structure, I do not see it as a stable EA for conservative long-term use. It can perform well for extended periods, especially in the right market conditions, but one that may also carry a very serious risk of a large loss when market behavior changes. So if you are evaluating this EA, I think the most important thing is not the smoothness of the equity curve. What matters is, how is it making money? What assumptions is it relying on? And what happens when those assumptions fail? That is the lens I used in my review. Personally, I believe FXStabilizer should only be approached as a high-risk EA and only by people who fully understand the downside structure. If someone is considering using it, I think there are 3 basic rules. First, do not judge it by performance alone. Second, do not increase lot size too aggressively. And third, always think about the worst case scenario before the upside. That is the key message of this review.